Hello and welcome. I am a hotel AI expert with extensive experience in modern hospitality operations and performance support. I am pleased to welcome all students of Europe Hotel School to your online learning journey. In this explainer, we're going to break down the financial feasibility method that top developers use to figure out if a hotel project is actually a smart investment. We look forward to supporting your professional growth in the hospitality industry.
So, let's get right into it. Why do hotels need their own special playbook when it comes to financial analysis? Well, it's because they're a bit of a unique beast. They're this fascinating and, pretty complex hybrid. On one side, you have this big, valuable piece of real estate. But on the other, you have a super high-intensity, 24/7, 7-day-a-week business running inside of it. That dual nature makes figuring out a hotel's value one of the most interesting challenges in the entire investment world.
And this right here, this really gets to the heart of the problem. Just think about an apartment building for a second. It's pretty stable, right? A tenant signs a lease for a year, maybe even longer. You have a very predictable, steady stream of income. Now, compare that to a hotel. It's a whole different ballgame. You are literally releasing every single one of your rooms every single night. That creates a level of daily revenue volatility that you just don't find in any other type of real estate, and it demands a much, much tougher financial approach.
Okay, so with all that day-to-day chaos, how in the world do you plan for the long term? How do you manage that kind of volatility? Well, the professional framework, the method we're diving into, it all starts with one single foundational concept, and that is focusing on what we call the stabilized year. This is the bedrock that every other calculation is built on top of.
You know, when a hotel first opens its doors, those first couple of years are, let's be honest, they're chaotic. You're trying to build brand awareness, you're working out all the operational kinks, you're just trying to ramp up your occupancy. You absolutely cannot base a 10-year financial forecast on that initial turbulence. So, the stabilized year is our target. It's that key point, usually around year 3 or 4, when the hotel has finally hit its stride. It's operating at a mature, sustainable, and predictable level, and that's our true starting line for any serious projection. This timeline here really lays it all out visually. You can see year 1 is all about that initial ramp up. Year 2, we're focused on growth, on grabbing market share. But our bullseye, the target for all of our accurate long-term forecasting, is that final stage, year 3 or 4, when we finally hit those stabilized operations. Everything we project for the future is based on how the hotel performs during this specific period. All right, so once we've locked in that stabilized year as our foundation, now we can build our financial model, or what we call a pro forma. And the absolute key here is to build it from the bottom up. This isn't about making big, sweeping guesses. No way. This is about getting down into the weeds, and I mean meticulously accounting for every single conceivable expense. We're talking food costs in the restaurant, the energy cost per occupied room, exact staffing levels, marketing budgets, and even setting aside cash for future maintenance. Accuracy here is absolutely everything. So, you've built this incredibly detailed financial model. Now what? How do you actually know if the project is a good idea? Is it a good investment? That brings us to the ultimate litmus test, the single most important metric for any serious institutional investor, the internal rate of return, or as you'll always hear it, the IRR. And here's the thing you have to understand about the IRR. It isn't just a snapshot of 1 year's profit. It actually measures the total performance of the investment over its entire life, from the day you first break ground to the day you sell the property, maybe 10 years down the line. It's the one number that captures the project's true long-term profitability, all expressed as a simple annual percentage. So why is everyone so obsessed with IRR? Well, it's pretty simple, really. All investing is a game of risk versus reward. An investor could take their money and put it into something super safe, like a government bond, and get a low but pretty much guaranteed return. To convince them to take on the much, much higher risk and volatility of developing a hotel, you'd better be offering a significantly higher potential return. This chart shows that expectation gap perfectly. The IRR has to be high enough to justify taking that risk. But look, building a model that looks perfect on paper just isn't enough. The mark of a true professional, what separates the pros from the amateurs, is preparing for when things don't go according to plan. And that's where we get to the reality check. Stress testing your financial model through what's called sensitivity analysis. I gotta say, this is my favorite part of the whole process because it's really the art of asking what if. What if the economy takes a nosedive? What if a new competitor opens up right across the street? Sensitivity analysis is all about throwing these negative scenarios at your beautiful financial model to see if it holds up, or if it completely breaks under the pressure. So let's play this out with a classic stress test question. Your whole plan is based on an average daily rate, an ADR of, say, $250. But what if you're wrong? What happens to your bottom line, to your ability to pay your debts, if you can only manage to get $230 a night? Does the whole project just collapse, or did you build in enough of a financial cushion to survive that hit?
Or how about this one? A very real-world scenario lately. A global supply chain issue hits, and the price of steel and lumber goes through the roof. Boom, your construction costs just jumped by 15%. Does your initial funding cover that? And more importantly, does the project still make financial sense? Does it still generate a strong enough IRR to be worthwhile? These are the tough questions this method forces you to answer up front.
And that is the entire point. Because the economy will have bumps in the road. Markets will fluctuate. It's a guarantee. By stress testing the model, a developer can move forward with real confidence, knowing their project isn't just built for a best-case scenario. It's resilient. It's built to survive the inevitable challenges that are definitely coming its way.
This brings us to the final and maybe the most important lesson in this whole framework. After all of this analysis, it is so easy to get fixated on a single number, like the final IRR. But if you do that, you'll be missing the entire point of the exercise.
Because this is the most important takeaway of all, financial feasibility isn't some magic number that guarantees success. It's an understanding of a range of possible outcomes. A great developer doesn't just find a project with a high IRR. They understand the risks, they manage the probabilities, and they build a strategy that protects the owner's capital no matter what the future holds. That is the true essence of professional hotel investment.